Why was the Glass-Steagall Act repealed? Have you ever wondered how banking regulations can shape the economy? One key piece of legislation in this area is the Glass-Steagall Act. Enacted in 1933, it aimed to stabilize the banking industry by separating commercial banking from investment banking. This separation was designed to protect depositors' money from risky investment practices, ultimately reducing the chances of bank failures. As time passed, the financial landscape changed significantly. Banks began to argue that the Glass-Steagall Act was outdated. They claimed it limited their ability to compete globally. Foreign banks were not bound by the same restrictions, and U.S. banks felt they needed to offer a wider range of services to stay competitive. In 1999, the Gramm-Leach-Bliley Act effectively repealed parts of the Glass-Steagall Act. This change allowed commercial banks to engage in investment activities once again. The repeal received support from both major political parties, showing a bipartisan agreement on the need for financial deregulation. Many believed that reducing government oversight would promote economic growth and efficiency. From a conservative viewpoint, the repeal aligned with free market principles. Republicans generally advocate for less government intervention in the economy. They argue that deregulation can lead to greater economic efficiency and competitiveness. However, some Republicans have raised concerns that the repeal might have encouraged banks to take excessive risks. They feared that banks could operate recklessly, knowing they might receive government bailouts if things went wrong. In recent years, there have been renewed discussions about reinstating some form of the Glass-Steagall Act. Both Democrats and Republicans have expressed worries about the risks posed by large banks and the potential for future financial crises. Some Republicans who support reinstatement argue that it could help prevent taxpayer bailouts. They believe that ensuring banks' profits are not privatized, while their losses are socialized, aligns with conservative values of limiting government intervention. The debate over the Glass-Steagall Act illustrates the ongoing tension between regulation and free market economics. As the financial industry continues to evolve, the conversation around the role of government in the economy remains relevant. Understanding the reasons behind the repeal of the Glass-Steagall Act helps us grasp the complexities of banking regulations and their impact on our economy today.